All right, everybody, 9 o'clock. Can everybody hear me okay? Because we are going to have this discussion, which Randy has patiently waited man, Randy, how long has that been? Quite a while, right? So my apologies on that. Yep. Okay. So what Randy wanted to know, folks, is the difference between a long call and a short put. Okay. Can everybody see the whiteboard? Great. So before we go into the specifics of a call versus put, and Randy, I'm going to ask these questions. You can answer them, or anybody can answer them, obviously. What is inherently the difference between a long position, which would be a debit position, where we, pay out money, and a short position where we're receiving money or we're receiving a credit? So, what are the P&L differences between the two? Okay, and then we'll go in specific to the long call versus short put. Okay, so this has nothing to do with IV, Alan, but you are correct. That is what we would do. Okay, Mickey. Good, Mickey, right on top of things this morning. Must have been because of your Packer win last night. Okay, John, nope, you've got it backwards. Short, you cannot have unlimited profit. Okay, so a long position, a debit, can potentially have unlimited profit. Okay, if you're just long an option, not a spread, we're just talking about a long option, long call or long put. Now, why do I say potentially have unlimited profit? Okay, why do I say potentially have unlimited profit? Got it, John. Thank you. I see that. Okay, that's on the Victor, that's on the call side. That is true, right? Theoretically, stock can go to infinity. So if you're long a call, theoretically that call has unlimited upside potential. How about a put though? If you're long a put, your profit potential really isn't unlimited. We're not talking about spreads, John. We're just talking about individual options right now. Okay, we're not talking about spreads. Exactly, Alan. Because in the real world, a stock can only go to zero. Okay, so if you are long a put, theoretically, you can only make money with the stock going down to zero. It's not unlimited. Okay, so a long position can potentially have unlimited profit. A short position, a credit, can only profit by the premium received. Okay, and remember here, we're talking about individual options. We are not talking about spreads right now. Okay, so Randy, are you clear with this? Randy, you good here? Well, have you been listening, Randy? Okay, so what did I say? A short option for either a put or a call. A short option is a credit. You can only make the amount of credit. Okay, we haven't broken down yet the long call versus short put. This was the initial part of the conversation, just getting down the fact of what can you make from a debit or a long position, and what can you make from a credit or a short position. Okay, all right, cool. Does everybody now, not just Randy, does everybody understand that concept of long debit, short credit? Okay, so now, Randy, give me a stock you want to look at and evaluate. Any stock. Okay, cool. So let's look at, let me put Apple up on the board here. And we'll go out to, yeah, I mean, it doesn't really matter what expiration we look at, but let's go out to the regular September expiration 2 weeks from now and just focus on at the money. Okay, we're going to focus on the at the money options. So right now, the 212 and a halves. Okay, so as you can see right here, the 212 and a half call is $4.35 and the 212 and a half put is $4. Okay, everybody got that? And I'll put that up on the whiteboard. This will be our reference point that we're going to use. Okay, so let's look at the Apple September 20th 212 and a half strike. Okay, so the call is trading for, I'm just going to round this off, 4.25, and the put is trading for $4. Okay, now these are the 212 and a half strikes. Okay, so if I buy this call, Randy, if I buy this call, okay, first off, at expiration, what would be my break even in the stock? Okay, so if I buy this call, what is my break even at expiration? Okay, we got two very different answers now. Now they're all starting to come in there. Okay, you guys are right. It's 216.75. Okay, Randy, do you understand that? And does everybody understand that? Okay, so, well, what does the 212 and a half call allow me to do, Pamela, or anyone else? Okay, what does the 212 and a half call allow me or any owner that owns that option allow me to do? Okay, good. Buy stock at the strike price, 212 and a half. Well, if I'm paying $4.25 for the right to buy stock at 212 and a half, then the stock's got to get up to 216.75 to break even. Okay, does that make sense, Pamela? Okay, so then Randy, if I own this call, which gives me the right to buy stock at 212.5, okay, what happens if the stock goes to 500 or 1,000 or 10,000? Besides the fact that if that happens, the market's going to rally, just gobs and gobs and gobs. But this is why theoretically, if you own the call and the stock moves, again, prior to the expiration of that call, I have unlimited upside potential. Right? I can make as much money as the stock goes up. Okay? Now, let me just put this answer here. Okay? And then, again, theoretically, the call can go to infinity, right? Realistically not, but theoretically, there is no upper limit to what that call could be worth. Now, what is the downside of, and I know you want to compare it to puts, but let's just evaluate all of the dynamics of the call first before we go to the put side of the ledger. Okay, good, Surya. You jumped ahead and you knew what I was going to ask. Okay, what if the stock goes to 212.50 or lower at expiration? Nope, Pamela, it's not unlimited downside. It is absolutely not unlimited downside. Right, it'll expire worthless, right? So I lose my investment. Right? Remember, Pamela, all you can lose on a debit is what you invest. Okay? Pamela, does that make sense? Okay. So the answer here is lose my investment. It's the most I could ever lose there. Okay? So kind of backtracking now, Randy, the long call side of things, you essentially, theoretically, have unlimited upside potential, and you can only lose what you paid for your long call. Okay, everybody got that? Everybody understand that before we move over to the put side of the ledger? Okay, so first, Randy, we're going to talk about a long put. Since we've discussed a long call or buying a call, let's stay on the debit side of things first, even though you want to get into the short put. Okay? So let's talk about what happens if, whoops, I want to go back to blue here, not red. Okay, so if I buy this put, what is my break even at expiration? Okay, it's obviously going to be much different than what the break even on the call side would be. So what would be my break even at expiration on the put side? Great. Yep. Okay, you guys all got it. Right? Because what does a put allow you to do? A put allows you to sell stock. It allows you to sell stock at the strike price. So if I'm now able to sell stock at 212 and a half, but I paid $4 for the right to do that, then the answer would be 208.50. Okay? Now, just as we did in the call scenario, what happens if the stock goes to 200, 150, 100, etc.? And just like the flip side, when it was going up, when, the market would probably be going up with it. If Apple is getting hit like this, then the overall market's probably going down. But what would happen there? Yeah, we're going to make a lot of money, right? Okay, we're going to make a lot of money. However, unlike, and I said this earlier, unlike on the call side where theoretically a stock can just keep going and going and going and really go to infinity, okay, what is the maximum I could make on a long put here in this scenario? What is the maximum amount I can make? It is defined. Exactly. It's 208.50. Okay, so does everybody get that? So again, there's a little bit of difference between reality and theoretical, right? So theoretically it's unlimited. In reality it's not, because the stock can only go to zero, right? Which is not going to happen. Well, I guess I shouldn't say that. Stranger things have happened, but if it did, we'd be in a whole lot of other trouble, right? Okay, so Randy, are we good with this so far on the long debit side of things before we flip this over and go to the sale or the short side of things? Everybody clear with this before we move on? Okay, Randy, I'm glad you are now, because I want to flip this over now. Okay, good. PJ, I'm glad you asked that, because I didn't address that. Okay, what if the stock goes up, right? That's the part I missed. Thank you, PJ. So what if the stock goes to 212.50 or higher at expiration? No, Alan. Nope. It's not unlimited loss. Remember, a debit, when you're buying an option, you don't have unlimited loss. Your loss is limited to the amount you paid for your option. So if the stock is 212.50 or higher at expiration, the put's going to be worth what? There you go, Len. Put's going to be worth 0, and the same thing with what happened to the call on the downside, what happened to the put on the upside. All you can lose is your investment. No, you didn't invest 212.50, Alan. Yes, PJ, I am. Yep. You didn't lose 212.50, Alan. All you can lose is the premium that you paid for the option, which in this case the put option was $4. No, you didn't receive 212.50. You didn't do anything with the stock, Alan. Okay, you didn't do anything with the stock. Remember, we're just talking about the option price right now. Okay, so PJ, thank you. Thank you. I had forgotten that. Thank you for asking that. Got that added in. Okay, so is everybody okay with this so far? That completes the debit side of the ledger. Alan, don't be sorry. Don't ever be sorry for making comments or putting in there what you think. This is how you learn. So it's all good. It's all good. Okay, let's flip this over now. Okay, and this is going to be um, call put discussion page 2. Okay, let's get the same exact example up here. Okay, so the Apple September 20th, 212.5 strike, 4.25 on the call, and $4 on the put. Okay, so the Apple Sep 20th, 212.5 call equals 4.25, put equals $4. Okay, so we have the exact same scenario here. Okay, so let's start on the call side. If I sell this call for 4.25, first off, what is my break even at expiration? Close, Shane. It's the exact same. Nope, David, nope. It's the exact same calculation. It's the exact same. Because the prices are the same. So it's the exact same as on the long side or the debit side. Okay, so that's going to be 216.75. Does everybody see that? Does everybody understand that? Okay, Randy? Okay, good. So that's my break even. Now, just as in the example of the long side, okay, just as in the long side, where to the upside in the stock there would be unlimited earning potential or unlimited profit potential, there is theoretically, and let me spell that right, theoretically unlimited loss potential in this situation. And why is that? Okay, why is that, guys? Exactly, David. You've got it. So both you and Len are on the same path there. Okay, so you would have to sell stock to someone at 212.5, but you collected 4.25 for the right to do that. So theoretically, essentially, you're selling stock at 216.75, and the stock can go to infinity again, right? So you basically have a short stock position at 216.75. Okay, does everybody get that? Okay. What happens if the stock is 212.50, 200, 175, etc. at expiration. Which part do you want me to say again, David? David, not sure what the last one about selling. Well, what does a call option allow the buyer to do? A call option allows the buyer of that option to buy stock at the strike price. So if I've sold that option, okay, that means whoever I sold it to has the right to buy stock from me. I have to sell them stock at the strike price. So I am essentially short stock at 212 and a half, which is the strike price, but I've collected $4.25. So essentially I'm short stock at 216.75 with unlimited upside loss potential. Stock goes to 500, 1,000, whatever it is, I am in a world of hurt. Okay? Now, if the stock is 212 and a half or lower, then Alan, David, you guys are correct. Drew, you're correct. The option goes out what? At expiration. If the stock is below the strike price, the option will be worthless. Perfect. Okay? And I would keep all of my premium. Okay, which means the maximum I could ever make, no matter how low the stock went here, would be the premium that I collected of $4.25. Okay, Randy, got it? Makes sense? Because if it does, now we're going to finally get into the part that you had asked about, the long call and the short put, which will be the next part. Okay, great. Does everybody else understand this so far before we go into the short put side of things? Awesome. Okay. Now, if I sell this put for $4, what is my break even at expiration? First off, okay, same as in the long put. Okay, 212 and a half. I've collected $4. Okay, so good. So it is 208 and a half. Okay, that would be my break even. Okay, so what happens if the stock is 205 or 180 or 160 at expiration? Right? I'm going to lose. No, David. No. This is being short the put, not long. This is short the put. What does short a put mean? Okay, what does that theoretically mean? If I'm short a put, what do I have to do if someone exercises their option? Exactly. If I'm short a put, that means someone. Nope, Malin. Nope, I'm obligated to buy the stock obligated to buy the stock at the strike price. Someone else who's long that put exercises their right to sell the stock at the strike price, and I'm obligated to buy it from them at the strike price. Okay? So if the stock is below that strike price and then below that break even of 208.50 here, I'm going to lose 1 for 1. Okay? So basically this position is like me being long stock at 208.50. Okay? So as the stock goes down and down and down, I lose more and more and more. However, like we spoke about earlier, theoretically, it's not unlimited loss potential because a stock can only go to zero. So, however, the loss potential is not unlimited because a stock can only go to zero. Okay, so even if the stock went to zero here, that is my max loss. My max loss could be 208.50, right? Because my break even is 208.50. If it goes to zero, I've lost it all. Okay, everybody with me? Okay, now what happens if the stock is 212.5, 220, 230, etc. at expiration? If it's above the strike price, what happens? Bingo. John, you got it. Kent, yep, the option will expire worthless, and we will keep all of our premium. So we keep all the premium. Okay, everybody got that one? Because now, Randy, I'm going to tie this together with the difference between the long call and the short put. Everybody okay with this? Randy, you good with this here on the short put side? Okay, so let me get another whiteboard up here. And let's tie this guy all together here. So, long call scenario. What can happen with my long call scenario? Just in general, okay? I have unlimited upside potential, and my loss is maxed at the premium paid for the long call. Okay. Understood there? Okay. And in my short put scenario, I have unlimited downside potential, at least until the stock goes to 0. Right? I'm maxed out, I'm capped out at that loss once the stock hits 0. And my upside, my profit, is maxed at the premium collected for the short put. Okay, did that kind of tie it all together, Randy? Did that help you out and clear things up a little bit for you? Well, that's downside potential. Yes, the downside is a loss. Good, John. Hopefully it's a bright one. Hopefully it's a bright one. Okay, so Pamela, good question. First off, we in this class are never naked short an option. Okay, we will always be hedged off by a spread, whether it's a call spread or a put spread, even if it's a short spread, which is what we do with our iron condors typically. That's how you protect yourself, David. You turn this into a spread so you have predefined risk. Okay? Now, we will never ever be short a naked option. We are at times, not very often, but at times we would be long a naked option because if we're long an option, our risk is predefined, right? The maximum we could ever lose on that is the amount that we've paid for that option. Stephen, I don't know how you could assume that. That is correct, Alan. If you buy a call, your risk is limited to the amount you've paid for that option, but your profit potential is unlimited. That is 100% accurate. Okay, so if you look on the whiteboard here, I think that's what we were talking here. Unlimited upside potential and the loss maxed out at the premium paid for that option. Sure, Julie, we'll do that another time, but absolutely. Okay? It is very rare, Pamela. Very, very rare. However, I would do that because our risk is limited. But I would never ever just put out a naked short put. Well, David, a calendar, we don't have a naked position on a calendar. We're protected by the long option. May not be the same expiration, but we're protected. Yes, I do, Mickey, all the time. I do naked short options by myself all the time because I mean you know I can manage it and you know okay. But for these signals that we send out here, you will never ever have a signal in this room where you are naked short an option. A lot of margin or a lot of capital in your account? Yes, that is true too, Steve. It takes up a lot of margin in your account to be naked an option, which is why when we do calendar spreads in here, we are always buying our calendar spread. We are never selling them. The reason being for that is if you sell a calendar spread, okay, the brokerage firms look at that as being short an option. Because theoretically, if you think of it, your long option, okay, your long option, which is shorter dated, could expire and leave you with a short option going further out. However, it's not the same when we're buying calendar spreads, because if the short option expires, we then have a long option against it. Okay? That's not true, Alan, at all. That is not true. In fact, I would say that nothing is further from the truth. You theoretically are, if you're long a call and you're long a stock, you want a stock, you want the stock to go up, but a stock can go up and your call option can go down in value very easily. Okay, and Steve, 100%. The leverage you get using options is humongous. Humongous. Well, here, guys, go back to page 1 of our explanation here. Okay, if I buy this call that we talked about, right? If I buy this call, we said that my break even at expiration on the call is 216.75, right? What happens if the stock goes to 216 at expiration? Well, if I was just long the stock, I would have made $3.50, right? From 212.5 to 216. But if the stock goes to 216, God, I don't know why this keeps flipping off of this. I'm sorry, guys. If the stock goes to 216, my long call is only worth $3.50, and I've lost 75 cents. Okay, so inherently, when you think about it, yes, a long call position, you want your stock to go up. However, it is not a one-for-one proposition. Okay, and I don't want to get too far into this, but the same thing, I can sell a put, and if the stock goes down, I can still make money. When you would think inherently, if I sell a put, I need the stock to at least not go down, just stay still, but I can still make money even if stock goes down. Okay. Exactly, Kent. Options allow you to control more shares at less cost. Okay. Anybody else? Any questions? Did this help, I hope? Yes, it is recorded. I will post it up here as soon as I am finished. Awesome. Well, you're very welcome, and thank Randy. And Randy's been asking me for a while on this. So Randy, my again, my apologies for not getting this sooner to you. So that's for another discussion, but that comes down to what we do on our evaluations. How do we come up with what is the proper type of spread, the proper signal that we come up with? And a lot of that is based off of volatility and expected move and all sorts of things like that. Okay? All right, guys, let me wrap this up. I will post it in the room. It'll probably take a little bit of time here since this has been almost an hour for the video to render, but let me get that going. I'll post this in the room, and I'll be back in a bit. David, what part of that are you confused with? Okay, but that's again, as I said, that is something that we go through on a case by case basis. And a lot of that depends on other factors such as implied volatility, support resistance, as to what we want, what we're looking for in a stock. Okay, it's not just, a one size fit all type of thing. Okay? Absolutely. All right, let me get this going here.